Thanks for joining us at xm.com for today's Daily Market Comment by Mario Hadjikyriacos. I'm Cristina Marujos. It has been a stormy couple of weeks for financial markets, with almost every asset class being rocked by expectations that the Fed will need to normalize monetary policy more aggressively to cool inflation. Market participants are fully pricing in for rate increases for this year. This has propelled U.S. Treasury yields much higher, and when the bond market begins to rumble, it feels like an earthquake for assets such as equities. This is especially true for the riskiest corners of the stock market. As such, global equity markets are a sea of red on Tuesday, feeling the heat of higher rates as the yield on 10-year Treasury bonds continues to ascend beyond pre-pandemic levels. The tech-heavy Nasdaq is leading the way lower, with futures pointing to losses of around 1.5%, when U.S. markets open today after a long weekend. This sense of caution has spilled over into the FX arena as well. The U.S. dollar is naturally outperforming, enjoying the perks of widening rate differentials between America and the rest of the world. Meanwhile, commodity-linked currencies like the Australian dollar are trading heavy. The yen has been unable to capitalize on the gloomy mood and instead is under pressure, suffering a double whammy from rising foreign yields and the Bank of Japan's reluctance to provide any signals that policy normalization is on the cards. But oil prices apparently didn't get the memo. Despite all the risk aversion, crude prices briefly touched a new 7-year high today, drawing power from renewed tensions in the Middle East and a rosier outlook for demand. The Canadian dollar has staged a powerful rally in recent weeks, turbocharged by expectations that the Bank of Canada will raise rates next week to counter inflationary pressures. However, that seems like a bridge too far, considering that wage growth is not impressive and that many provinces have reintroduced tough restrictions to counter Omicron lately. Hence, the risk-to-reward profile for the Loonie heading into next week's decision doesn't seem very attractive. The picture will become clearer tomorrow with the release of the nation's latest inflation data. Finally, gold prices have shown remarkable resilience in the face of bad news lately. Bullion has remained unfazed within a narrow range, and if intensifying speculation for Fed rate hikes and soaring yields aren't enough to sink gold, most of the negativity might be priced in already. Thank you for watching today's Daily Market Comment here at xm.com.